Today is we want to learn on how to tax business. We want to learn how to tax business income, taxation of business income. So far, we have looked at employment, although not very conclusive. It's conclusive unless now you are unable to tackle question on employment income. So you keep on doing question on employment income, and if you encounter issues or questions that you are not unable to handle, and then we can discuss or we can do it together. You notify me so that we do it together. So today we want to look at taxation of business income. So at your level, when we talk about business income, we are talking about three business entities. Number one is a sole proprietorship business. That is a business that is owned by one person, or a partnership business and a company. So your syllabus requires that you are able to tax those three business entities. So now I've shared the notes that you're going to use. And when you go to that handout, the first paragraph there, I have listed we call them, so business income is one of the specified sources of income in Kenya. So in Kenya here, we have 5 sources of income that are supposed to be taxed separately. That one is called, number one is called specified sources of income, specified sources of income. So this one, number one is what we call employment income. Employment income. Number two is what is called business income. And number three is what we call investment income. Number four is what we call rental income. And number five is what is called farming income. So these are the sources that are recognized in Kenya for tax purposes. So if you have income that is originating from these sources, then it's supposed to be taxed on its own, not to be combined together for purposes of tax. Each and every source should be indicated separately and then taxed on its own. So far, we have done with employment income, and while doing employment, we touched on these two. So today we want to look at business and maybe farming. So now, when you're looking at business income, when you're doing business, how do you determine, what are the factors that you consider for you to determine whether business is being carried on for purposes of tax or not? The factors to be considered in order to determine whether business is being carried on for the purposes of tax or not. Number one, you look at the motive of the motive, or if the motive, is it profit motive or not? If you sell an item just once, for example, you have a phone and you just sell it and you don't buy another item for resale. You don't buy another phone for resale, isn't it? So you don't have that profit motive. That motive is what we look at. And the motive is revealed by your actions. Whether after you sold an item, are you going to buy the same item to resell it again? If you do that one, then the motive is business. Number two, we look at the nature of assets and the quantities. So for example, you cannot buy a lorry for the purposes of private use, isn't it? If you buy a lorry, it's already the nature, it is indicating that this is business. Can you buy a tractor for your own personal use? No, that one is business, isn't it? So you look at the nature of and the quantities involved. Then number two, we look at the method of financing. So the proceeds, the amount of money that you receive from the sale of the item, if you use the same again to buy another item, then it is an indicator that you're doing business. And then we look at the method of acquiring asset. If you inherit an asset, you can inherit an asset, that one we don't consider it as a business. Or if you buy an asset, then you buying assets of large quantities, in large quantities, then that is an indicator that you're doing business. And then now when you're doing business, you receive a lot of incomes. You receive incomes, isn't it? Some of these incomes are taxed and others are not taxed. Not all business income are taxed. So you're supposed to know what we call taxable business income. Taxable business income. Taxable business income. So when you're doing business, you can receive a lot of incomes, but we need to know those ones that are supposed to be taxed. So number one is what we call the insurance compensation. Insurance compensation insurance compensation for the loss of revenue item, for the loss of revenue items, or stock items. So if you insure your stocks against a particular risk, and that risk occurs and you're compensated, that compensation is treated as business taxable business income. So there are two kinds of insurance that you can have. You can insure risk against insurance on capital item or non-current assets, like maybe motor vehicles, buildings, furniture, etc. So if you insure non-current assets and the risk occurs and you're compensated, that one is not taxable income. But if you insure stock items and revenue items, like maybe loss of cash, not loss of cash, stock item mostly, stock items, that one will be, if you're compensated for that kind of loss. Then number two is what we call realized foreign exchange gain. Realized foreign exchange gain. So you're doing business internationally and you are favored, there's a favorable exchange rate. For example, you're selling items to Sudan. So you sell 100,000 items. At the date of invoicing, maybe $1 was exchanging to, $1 was exchanging to 10 shillings, isn't it? $1 was exchanging to 10 shillings. Then now when you're being paid, $1 is exchanging at 12, so you gain 2 shillings on the exchange rate. And then this amount already they have paid you, the amount is in your bank account. Then that one we say it is realized foreign exchange gain. So you've gained as a result of this business. So you see you are gaining 2 shillings per item, isn't it? So this one will be around 200,000. So that one will be realized. Realized means you've received the gain, it is already banked, it is in your account. That is what it means, realized. So that one is considered as a taxable business. And then there is what we call balancing charge and trading receipt for investment. Number 3, balancing charge and trading receipts. So we'll learn about balancing charge and trading receipts as we progress or proceed. But in the meantime, when you invest in capital items, you are given an allowance by the government. We call it investment allowance. When you buy machines for business or you buy non-current asset for business, for example, you can buy a computer whose value is 10,000, or you buy a furniture whose value is 10,000. Currently, if you buy a furniture, you're given an allowance of 10% of the cost. So we call it investment allowance. You're given investment allowance of 1,000 here. So now the written down value after the investment allowance here will be 9,000. And then you decide to sell off this asset at this point, and you sell it in excess of the written down value. You sell it revenue that is more than the written down value. For example, you sell it at 10,000. So you gain how much? 1,000. So now that is called trading receipt. If the business is still a going concern or still in operation, or a balancing charge if the business is coming to an end. So a trading receipt is where you sell an item at a value that is greater than the written down value. The surplus is called trading receipts if the business is still in operation, or balancing charge if the business is under liquidation. And those are taxable business income. And then now, I hope you're following the handout. You're looking at the taxable business income. Then number 4 is what we call the bad debts recovered, which were previously written off and allowed. So bad debts occurs when you sell on credit. When you sell on credit, some of the debtors don't pay. So when they don't pay, you write them off, but you don't inform them that you've written off their debt, isn't it? Maybe later on they decide to pay. If somebody is declared bankrupt, you will have to be compelled to write off the debt that was owing, but you don't inform them. So if they gain capacity in the future and they decide to pay, that we call it recovered bad debts, and that is considered taxable business income. So recovered bad debts, these ones are considered as taxable business income. And then number 4, where business is carried on partly in Kenya and partly outside Kenya, the profit from the business are deemed to have been generated in Kenya and therefore taxable in Kenya. So when you're doing business in Kenya and in another country on partly basis, so you're here in Kenya and maybe Uganda, the entire profit that is generated from that particular business will be deemed to have come to have originated from Kenya, and it will be taxed here in Kenya. Then number 6, we are looking at the taxable business income. There is what we call reduction in specific provision for bad debts. Reduction is specific. So what is a provision? A provision is an amount that is set aside to cater for a particular eventuality. Sometimes we set aside some amount to cater for those debtors that will not pay. So we have what we call specific. So we can say, let us put aside 10,000 from our profits to stand in for those debtors that will not pay, isn't it? And then after some time, we analyze what was the response from the debtors. If they complied, then there's no need for us to hold this amount in that account, isn't it? So this amount needs to be reduced because now debtors are paying more and more, isn't it? So why should we hold this amount? So why don't we bring it back to business to circulate and generate more revenue, isn't it? So we can say, let us now hold 5,000 because the debtors are behaving well. So this reduction is treated as taxable business income if the provision was specific. So we have two kinds of provision. We have specific and general. Specific, it must bear the word specific. So if specific reduces, then it is considered as taxable business income. So we have specific and general. So general, if the question just tell you that there was a reduction in provision for bad debts without the word specific, then that one is general. So that one is treated as taxable business income. And lastly, a gain arising from buying and selling. So if you buy and sell and you're doing business, the gain is taxable income. And then we also have some income that can be received by a business entity and they are not taxable income. So we call them non-taxable business income, which you're also supposed to know. We call them non-taxable business income. Non-taxable business income. Number 1 is income from foreign investment. So if you invest in abroad, in a foreign country, and then you receive income from such an investment, then they will not be taxed here in Kenya. Income from foreign investment. And then number 2, reduction in general provision for bad and doubtful debts. So we said specific, it is taxable. General is not taxable. And then additional capital introduced in business. Additional capital. If you introduce additional capital in business, that one is not considered as taxable income. And then another item that is not listed there, it is gain on sale of non-current asset. Gain on sale of non-current asset. You can include that one. Gain on sale of non-current assets. Gain on sale of non-current asset. And then another one is the insurance compensation on capital. Insurance compensation on non-current asset. On non-current assets or capital items. So those are some of the income that are not taxed. And then any income that is exempted from tax under the first schedule of the Income Tax Act, e.g. inheritance. When you inherit something, is it not income? If you inherit money from your uncle, then you channel it in business, is it not income to you? It is. That one is not in. Or you receive dowry for your when your daughter is being married, is it not income? And then you channel it in business. That one is not it's not taxable income. Okay, so you need to know that. So we have already analyzed what we call taxable business income and non-taxable. And then very important, as far as business is concerned, is what we call allowable and disallowable. This one is very, very important. Allowable expenses. Allowable expenses. Allowable expenses. So now when you're being taxed, when you're doing business, you're taxed on the net income. In other words, you have the gross profit here, the gross profit, and then you less expenses. You less expenses. It is this net income, you get the net profit or net income here. It is the net income that is taxed. Now, these expenses here, we have expenses that they are allowed to be deducted from your gross income and others are not allowed. So you need to be aware of those ones that are allowed and those ones that are not allowed. So what are allowable expenses? According to the Income Tax Act, an expense is considered allowable if it assisted you to generate taxable income. The guiding principle is subject to the provision of the Income Tax Act. These are expenses which are wholly and exclusively incurred in production, of income. So those expenses that are assisted you to produce a taxable income. So I have listed some of them, which are very common. Number one is what we call the trade bad debts. Trade bad debts and increase in specific or allowance for doubtful debts. A bad debt, as I had explained earlier, occurs when you sell on credit and the debtor is in a position not to pay. You specifically identify a particular debtor that will not pay a particular amount. That amount is allowable. It is allowed for you to deduct by the tax person or the taxman. Or increase in specific. Specific, we said when it reduces, it is treated as income. When it increases, it is an expense allowable. And then we have what we used to call them capital allowances. Nowadays, we call them investment allowance. That is a topic on its own. It is a topic that we'll look at after this one. So investment allowances occurs when you invest in non-current assets. So there's an allowance that you're given. That allowance is allowable. We'll learn about it. And then we have number three, legal cost in connection with the acquisition of lease of not more than 99 years. So when you're leasing an asset whose lease period is 99 years and below, so there are legal costs that are connected to that particular transaction, isn't it? You can, if you're leasing a building, this building, you must have a lawyer, is it involved, isn't it? And the lawyer, you'll pay some amount for the legal services. So long as the lease agreement is less of 99 years, then the legal expenses will be allowable. The legal expenses will be allowable, provided the lease agreement is of 99 years and less. And then number 4, subscription to a trade association. Not all kind of subscription. We are very specific here. Subscription to a trade association. Subscription to a trade association. And then number 5, expenses of capital revenue in nature on scientific research related to the business. So if you're doing a particular business and then you sponsor a particular research that is connected to that business, both capital and revenue. Capital means you're buying capital items. You know the difference between capital and revenue? You know the difference? When you talk about revenue expenditure and the capital expenditure is expenditure on those items that assist you to generate more income, isn't it? And then revenue expenditure is expenditure on day-to-day operational activities. So now, if you spend money, both revenue and capital, on scientific research that is connected to the business that you're doing. For example, you are running a hospital, and then you sponsor a university student to undertake a research on a particular disease, isn't it? Then you give them money, both capital, they can buy capital equipment, maybe the one that conduct more tests, and then you can pay them some allowances. All of that amount will be allowable, provided the business. And then number 6, we have what we call business pre-commencement expenses, provided that the expenditure will be deductible if it is incurred after the commencement of the business. So when you're commencing a business, you incur both capital and revenue, isn't it? So those revenue expenses that you incur before the commencement of business, after the commencement, they can be allowed, isn't it? But if the question just right there, pre-commencement expenses, you will disallow them because you don't know. It might be a combination, isn't it? A combination of both revenue and capital. Okay? So you come on, and then we have interest on loans for developing the business. So if you acquire a loan, you have to pay interest on the loan. So the interest on loan will be allowable, provided that the loan is for business purposes. So now, and then advertising expenses. So we have advertising expenses of revenue in nature. Sometimes we can advertise, capital advertising. When you advertise on billboards, signposts, neon